Hello everybody, another medium-term budget policy statement has been read, and the first place we look is the debt ratio to give us an idea of whether we're moving towards a more sustainable fiscal position or not. So the good news is that the budget does show a peak in the debt ratio next year at 75.5% of GDP and then slightly down in the following two fiscal years. The debt trajectory, however, has lifted a little bit compared to the previous projection of February this year. And the reason for that is we've had a bit of a slippage on the main budget deficit. We're looking at 4.7% of GDP this year rather than the minus 4.3% of GDP projected in February. Reason for that is tax collections disappointed, just over 20 billion rand. This despite the fact that individuals were not compensated for bracket creep in the current fiscal year, costing around 16.3 billion rand to individuals. And of course, even if there is a full adjustment for inflation in the next fiscal years, there's still a carry-through effect of about 17.3 billion rand next year and 18.6 billion rand the year thereafter. But despite that, we've had this tax shortfall, also a little bit of overspending on non-interest spending of about just over 10 billion rand. However, in the medium term, that deficit does come down to 3.4% of GDP. The key thing, though, to watch is the primary budget balance. That's the revenue less non-interest spending, and that's projected to improve from a surplus of 0.4% of GDP this year to 1.8% of GDP by 2027-2028, and that's what helps stabilize the debt ratio. There will be some question marks, though. The better performance of the debt ratio, the trajectory has been flatter of late. Part of the reason is the use of the JAFECRA balances at the Reserve Bank. Some of that will still be used next fiscal year and the one thereafter, but then that falls away. And of course, over the medium to longer term, we need to get growth going, otherwise unemployment stays high and socioeconomic spending pressures remain high. We also know still around national health insurance, there could be additional spending pressures coming from that over the longer term. And then of course, the budget doesn't show transfers to state-owned companies in the years ahead, and there is always some risk there as well. And then as the budget mentions, wage increases. So over the next 3 years, an average of 4.5% per year in the total compensation bill. We'll only really know around budget time next year whether that's going to have to be exceeded or not. So there are those question marks behind the long-term fiscal consolidation, but the overall plan is the right one. And the way that the government is going about things is they realize that we have to grow this economy faster to make the fiscal maths work out. And there's this very strong emphasis on infrastructure spending. There's also a realization that this is going to take a lot of funding, so the budget does take time to actually look at that, talking about blended finance, credit guarantees. But what I thought was really encouraging was that the budget also talks about a separate category for debt taken on board to fund infrastructure projects, so that you would make it clear that borrowing is for that purpose. And that is important because at the end of the day, fiscal consolidation is not just about reducing the budget deficit and the debt ratio, it's also about stabilizing the balance sheet of the state. And to the extent that you do borrowing, you do want it to be for capital expenditure. So an emphasis on that is always welcome. But overall, not many surprises. A government still looking to do fiscal consolidation over the medium term to stabilize and reduce that debt ratio to make this fiscal policy sustainable. So we are slowly but surely moving in the right direction. The key thing, though, is we have to deliver on our infrastructure and our overall economic reforms to make the economy grow faster. If we manage to do that, that would help towards stabilizing the debt ratio and keeping fiscal policy sustainable. Thank you.